My name is Kevin McNab with Ace Wealth Partners. Today I'll take a look at the recent downward stock market volatility as it relates to my clients and provide perspective. When the markets are volatile, when we see losses in the stock market, I always go back to a Warren Buffett quote. Be fearful when others are greedy and greedy when others are fearful. With that in mind, we'll go to the next slide. So here's some terms that you've probably heard on the news over the last few weeks, and they're terms that I'll use throughout this presentation. So first, a correction is a loss of 10% or more from a recent high. So on average, we see a correction about every 2 years. That doesn't mean it's going to happen exactly every 2 years. For example, we saw a quick correction the beginning part of this year, which I call the Super Bowl correction, which was the end of January to the beginning of February. On average, a correction lasts 4 months with a 13% decline. Next, a bear market is a loss of 20% or more from a recent high. So since World War II, bear markets have lasted on average just over a year and lost 30.4%, with an average of 22 months to recover. A recession is 2 straight quarters of negative GDP, or gross domestic product. So oftentimes a recession and a bear market come together, but that's not necessarily the case. We could have a bear market without a recession. So if you look at the current stock market decline, we have reached bear market territory. So Monday, December 24th, the S&P 500 dropped 20% from its 52-week high. Merry Christmas. So if we're looking at the context of where we're at right now, we're in a very shallow bear market. Now, on the side of the screen, I put a chart that shows bear markets and corrections in the S&P 500 since World War II. Now, it's very hard to read, so I don't expect you to be able to read this, but the point to this chart is that a bear market, a correction, they are normal. And they're so normal that I couldn't fit all of them onto a slide where you could read them. We can also look at that in a different context with a chart. So when we look at this chart, it's from 1926 through September of 2018. So keep in mind that the recent bear market is not included. A bull market in the blue is the time in between bear markets when stock market returns are generally going up. You'll notice that the increase is not smooth. So we can be in a bear market and have a bull market and still have corrections. The average bull market lasted 9.1 years with a cumulative total return of 480%, which is fairly significant. The average bear market period lasted 1.4 years with an average cumulative loss of just negative 41%. If you look at the chart, bear markets recover quickly, and you don't want to be out of the market during the recovery. Multiple studies have shown that trying to time the market is nearly impossible. Which leads us to this: why is the market declining? There's always several factors, but here are the main factors. Number one is the trade war with China. So I'm sitting here on January 3rd, and the stock market is down significantly. And one of the reasons it is down significantly is because Apple came out with a report that its sales in China are declining. They had poor sales, and they attribute that decline to the trade war. Fear of an over-aggressive Fed, and an overall fear of slowing economic growth. That doesn't necessarily mean a recession, but just year-over-year growth that is not as high as it has been in the past. Which brings us to the next slide, which is, I think, a fascinating chart by Novel Investor. Investors and news outlets always focus only on the domestic stock market, but no prudent investor would invest 100% in U.S. stocks. So this chart shows the highest returning asset class each year from top to bottom by color. So here, when I look at this, here's a few takeaways. It is impossible to determine year over year which asset class will perform best. For example, emerging markets was the highest performing asset class in 2017. It was the lowest performing asset class in 2018. Over the last 5 years, large cap stocks have 3 years of very good returns. They also have 2 years of poor performance, even during a bull market. Also, if you have a diversified portfolio, large and small cap stocks have an acceptable return over the last few years, but most other asset classes actually do not. Most important, look long term. I know it's cliche, but look long term. Just because bonds and international stocks have underperformed their historical returns recently does not mean they're poor asset classes and should not be part of your overall portfolio. So what can you do? What you can do is don't panic or make emotional decisions. Now, what we have done is shorten up the duration of your bonds during a rising interest rate environment. We've used alternative asset classes and strategies to help diversify your portfolio when some of the traditional asset classes have not done as well over the last few years. And we tighten up your allocation, our client's allocation, over the summer heading into this bear market. Just remember, you have a custom asset allocation set up for each financial goal. So the other thing you can do is please call or email me with questions at any time. If you feel panicked, if you want to talk, again, please give me a call. Also, with this presentation, please feel free to pass it along to friends, family, or coworkers if you think it might help them. Thank you, and I appreciate your time.